The long-awaited interest rate hike is finally here. The Federal Reserve increased the interest rate by 25 basis points, and there might be 6 more rate hikes coming soon in this year and probably next year. Now, in theory, interest rate hikes are supposed to make the stock market looks less attractive, as higher interest rate means increased borrowing costs for the companies and also consumers like you and I, therefore lowering overall spending. Because less companies will take loans for their businesses, less people will take out mortgage for new house as well as car loans. People will also save more money as the banks are giving higher interest rate, and this will also eventually make people to spend less. At least these are what I learned when I was studying for my bachelor degree. But this is just theory because this is never the case in the stock market. In fact, the S&P 500 has been going up for 4 consecutive days during the past week. And these 4 days are not just some ordinary green days in the market. On Tuesday, which is the day before the Fed announcement, the S&P 500 went up by 2.14%. On Wednesday, the market did trade lower, but it posted a 2.24% gain during the close. On Thursday and Friday, the market went up by 1.23% and 1.17% respectively, bringing the net gain for the week to 6.16% for the S&P 500. Same goes to the Dow and Nasdaq. These major indexes were having 4 great consecutive gains during the past week. On the 6th of March, I posted a video sharing my personal opinions and thoughts on the stock market. During that time, I also said that there is a slim chance that the market is bottoming out, and I was still buying and holding on my investments. I shared that as well. And I would say that the market bottom is not confirmed just yet, but it is moving towards a very promising direction at the point of recording this video. So in this video, I want to make a follow-up video about the current market situation right now as the interest rate is finally being raised. Then I will also share my commentaries on the market from a technical perspective using technical analysis. And also, before wrapping up this video, I will share with you the potential tripwire of this potential bull run. Let's talk about the historical impact of rate hikes towards the stock market movements a little bit. In one of my previous videos, I shared the historical stock market reaction when there is a rate hike of 50 basis points. Now, despite we do not have a 50 basis point hike this time round, but I think the findings that I have shared in that video is pretty useful as well. So as usually, I'll link it up in the YouTube card if you want to check that video out. So this is the first rate hike after 4 years. According to a research done by LPL Financial, in the previous 8 hiking cycles, the S&P 500 carries a 50% chance of posting a gain 3 months after the first rate hike. For 6 months after the first hike, the S&P 500 or the market has a 75% chance to go up, and the S&P 500 was posting gain 1 year after the first rate hike every single time. So looking at this piece of historical data, as long as you stay invested, your investment will post some gains after a year. Again, theoretically, rate hike is not doing any good to the stock market, but again, the real stock market is never a place whereby theories or logic speaks the loudest. Oftentimes, things are pretty counterintuitive. According to the CEO of Quant Data, usually the stock market is reflecting what's best for the economy. So if interest rate hikes are best for the economy, then stocks will respond to that. I super agree with this statement. The financial market is a place whereby we are always dealing with humans. We have to deal with the psychology of every single player in the market. And people have been expecting the Fed to increase the rate because that's the one best logical move to tame inflation. And with the Russia-Ukraine war that is happening that causes the oil to shoot up higher, the Fed has to do something. So all these expectations have been priced into the market. However, as long as the final statement is not being made, there is still some, uncertainty, and the market does not like uncertainty. This is one of the reasons why the market has been so volatile for the past few months because, people are expecting a rate hike, but it hasn't been done until last Wednesday. So now the rate hike is already confirmed. Market players can start planning for the next moves, and that's why we see stock prices are going back up for the past few days. The movement of the past few days could also be the stock market reflecting that the Fed has finally made a decision that is best to the economy or the market. So people are expecting that the rate hikes probably and those upcoming rate hikes are going to tame inflation and do good for the market overall. So that's why the market sees some optimism lately. Now, whether this upward movement is going to be sustainable, we shall see in the next few weeks perhaps. Whether or not the market will start a bull run, we really couldn't tell for now, but one thing that we have to agree is that for the past 3 decades, none of the rate hikes have killed the stock market or put the stock market into situations whereby things are devastating. The next thing we're going to investigate is the sectors that are leading the stock market post-rate hikes. Looking at this chart, we can see that the technology sector outperforms the rest with an annualized return of 20.6% after interest rate hikes. Now, this is because technology sector will usually have a wild swing in price when it is threatened by inflation and it affects the way of valuation these tech companies are being done. So once the rate hike is being confirmed, people in the market believe that the inflation will be controlled and tamed soon. So the tech stocks recover as people are expecting their previous worries to be kind of like resolved. And this is exactly what we see in the stock market right now. The tech stocks are the ones that suffered the most during this correction, with Nasdaq falling more than 20% from their all-time high. From last week's movement, we can also see that Nasdaq was picking back up pretty well. Again, about 2 months ago, I posted a video revealing 3 investments that I will personally make if the market were to crash in 2022. And all of these 3 investments are related to the technology sector. Apart from me being bullish on the tech sector over the super long run, because everything in our life right now is related to some sorts of technology, what I've just shared with you just now is also part of the reasons why I focus on the technology sector when the market actually falls. Wild swings, high volatility on a sector that is bullish over the long run, it sure sounds risky to some people, but for investment purposes, it means great opportunity. From a technical perspective, the S&P 500 has gone back up above the 200-day exponential moving average, which is the green line in the chart. And we have already seen a higher high, right over here, and also a higher low in this chart. So from a technical perspective, I would say that the market is looking a little bit more technically, a little bit more bullish right now, but things are not confirmed to be bullish just yet. The market has gone up by 4 consecutive days, and these are rather big movements for the indexes. It is a little bit unrealistic for us to expect the market to go up with this kind of momentum over the short run. So short-term wise, expect a pullback to this resistance level. So let me draw out the possible resistance level. So the first resistance level could be here, and the second resistance level could be this short-term average right over here. So those levels are somewhere around 4,400 as well as 4,350, somewhere around those regions. Now, if the S&P 500 were to pull back to either this region or this region, and this region can change, just to let you know, because this region I plotted based on the orange line right over here. So if the market were to hit this region and then go back up again, I would say that the stock market rally is very much likely to happen. Looking at the Dow, things are pretty much the same. Right now, the Dow is trading above the 200 days exponential moving average, as indicates as a green moving average in this chart, and it is also having a higher high as well as a higher low in the chart, indicates that this is a little bit more bullish compared to where it was a couple of weeks ago. And short-term wise, we also want to expect the Dow will retrace back to either this region or this region as I have drawn in the yellow rectangle in the chart right over here. Moving on to the Nasdaq, we had a double bottom right over here, and it also has a higher high compared to this high, but the problem right now is it is trading at a resistance right now, as you can see from the blue line. So short-term wise, the Nasdaq is very much likely to pull back to this region as indicates as a yellow rectangle in the chart right now. I would also say that if you are having a trading portfolio, which means a portfolio that is not meant for long-term investments, it is meant for like short to mid-term capital gain. Once the major indexes pull back and then continue rally, you can start going into a little bit more aggressive on finding some strong sectors and strong stocks to trade. But again, do not forget your risk management. So from a technical perspective, we are also seeing things moving towards the bullish side right now. And we can somehow see light at the end of the tunnel already. Coupled with the historical data that we have known so far about the impact of rate hikes towards the stock market, I would say that what we are experiencing right now are somewhat congruent. Now, before you go and withdraw your savings and pump them into the stock market, here's a tripwire that you need to know. And that's the oil shock. Now, during the January Fed meeting, we didn't have the war. So maybe during that time, the Fed was less stressful when it comes to rate hike. But as the war started, which is believed to be the main culprit of the sky-high oil price right now, the Fed is under stress and has no choice but to increase the interest rate to tame and control the inflation. The problem with high crude oil price is higher inflation. With crude oil becomes more expensive, transportation costs will be expensive as well, and therefore it basically brings up the prices of every consumer goods by a notch. Imagine that you are running a business, whatever business. Then all of a sudden, the cost of bringing in new inventories increase simply because you have to pay more for the transportation fee to get those goods to your doorstep. Under most circumstances, business owners will start increasing the selling price of your goods and services. Now, seeing things from a consumer's standpoint, everything around us is increasing in price, but if your wages do not increase enough to catch up with the sky-high inflation that we have right now, then it generally means our purchasing power decreases. When the purchasing power or spending power of the general public decreases, economic activities will decrease as well. The sky-high crude oil price will really create a domino effect here as it affects a lot of things, and those a lot of things will impact other things as well. Now, oil shocks have caused economic downturns in the past, namely in the mid-1970s, early 1980s, and early 1990s. So if the oil price keeps staying at the level right now, this could be the tripwire of this potential bull run that we have just discussed just now. Now, there are some positive negotiations between Ukraine and Russia, but I think instead of being blindly bullish that the war will come to an end very soon, we still need to kind of acknowledge that the risk of inflation going up due to oil price is still intact until the day we see crude oil prices really comes down. So what's the final word here? Judging from the history as well as seeing things from the technical perspective, the stock market is definitely moving towards a very positive and promising direction. If you are an investor or you have an investment portfolio to work with, you should have by right collected some great ETFs or some great stocks for the past few weeks or even months. If you are dollar cost averaging on ETFs like the S&P 500 index ETF or other great ETFs like the QQQ, just keep doing it and you will be a winner in the market without even timing the market. If you are a trader, then it much depends on what strategies you are using to manage your trading portfolio. Now, as a position trader personally who use the trend following strategy, I will increase my aggressiveness in trading stocks that are trending up or in an uptrend if the market continues to go up. But here's a big but, okay? We do not know if this is the beginning of a recovery or it is just going to be a dead cat bounce, as this so-called potential bull run has a tripwire as discussed just now. So from a technical perspective, it is better to wait for a pullback first and see how things will progress. Now, understand that even in the bull run, the market doesn't go up in a straight line. There are going to be pullbacks or mini correction as well. The only thing is the upward movement is bigger than a downward movement in an uptrend or market bull run. So if the market were to bottom out and recover from where it is right now, I would say wait for a pullback and see where the market lands on, because it is kind of, unrealistic for the market to go up like how it did for the past 4 trading days, although if the market wants, it could. Now, if the market retraces a bit, then continue to create a new high, then I would say things are even more promising. So personally, I have collected some great ETFs during the past 2 months for my investment portfolios. So should the market moves up and goes into a bull run, I'll be focusing more on my trading portfolio to capture more capital gain when the market is strong. And I do not have to worry about my investment portfolio because in a bull run, it will definitely do great. Now, if the market does not go into a bull run, I'll keep dollar cost average on my investment portfolios and then add up more great ETFs for every predetermined percentage of drop. Alright, that'll be all for this video. A rather quick update on how I think about the current situation of the stock market. If you like this video, do not forget to give a thumb up, alright, and subscribe to my channel for more content like this. Turn on the notification bell as well so that you don't miss any updates. With that said, thanks for watching and I will see you when I see you. Peace out.